Today, we're asking the question: is a properly designed, high cash value, dividend paying life insurance policy right for a young entrepreneur? Um, if you're not familiar, the shorthand name for that big long thing that I said is infinite banking or bank on yourself. I'm a bank on yourself professional. Today, I'm just sharing a case study that might help you decide how you would answer this question. Welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps you create your unique, feminine, and entrepreneurial path to financial independence. Please be sure to subscribe. And if you're watching on YouTube, hit the bell for future episodes. So, today I want to introduce you to Joe. Joe is 29 years old, or used to be when this story starts. And Joe, at that point, would say these things: "We don't think there's enough money coming into the business. I'm concerned about making the right financial decisions. In the next few years, we'd like to buy a home and we plan to stay for the long term. We want to get and stay out of debt personally and with the business. And we want stable income while we're doing something that brings us life." Word for word, what was written down, what Joe said back when Joe was 29 and starting the case study that we're sharing today. As you might imagine, right, the business revenue up and down, but wanting to be responsible, wanting to have a safe, like home to live in that could count on through those ups and downs of the business, not having to worry about paying debt when business revenue goes up and down, right? And ultimately getting out of having the business go up and down in terms of revenue, maybe getting to a more stable income. And so, what did Joe do? I've got personally and then within the business, because they're separate, but they go together. So, I wanted to kind of share them side by side here. So, personally, Joe started creating a safety net to withstand the ups and downs of business. Now, this safety net ended up being a properly designed high cash value dividend paying life insurance policy that, in the infinite banking, bank on yourself scenario. And that policy for Joe allowed multiple safety nets. I want to share three of them: liquid cash if needed. So, building up the safety net of when business was low, there would be liquid cash to access without any penalty or, taxes due or anything like that. But also getting an uninterrupted compound growth. There's a huge risk of, when you do need access to cash, losing the opportunity of what that cash could grow into. And so this policy provided for Joe that growth would continue without getting interrupted, even while using it, right, when and if needed. And then also having that death benefit and accelerated death benefits in case something happens, whether Joe gets sick, gets cancer, dies, right, whatever. There would be something to help whoever is help taking care of Joe, or is taking care of Joe's final, expenses and continuing the business. So Joe used savings to get going with that first 6 months. Joe did have a little bit of a safety net, but not much. And so that safety net that Joe had already kind of started building allowed Joe to get started. And then the plan was to figure out within those 6 months how to keep going with building this safety net, because that would be really important to Joe, to have that stability, right? That no matter what happens with the business, Joe would be okay. And so, um, to help make that happen personally, there was a few things that needed to happen within the business as well. Joe decided to focus on 1% improvements to both the top line revenue and to the profitability. So, what does that look like? Increasing sales, that's the improving the top line, and lowering costs, that's the improving the profitability. And if Joe could do 1% improvements, right? So 1% the first month becomes 2% the second month, 3% the fourth, or the third month, right? by 6 months, there'd be a 6% improvement. Maybe Joe gets to take more home, right? To be able to continue building that safety net outside the business. And the business is just running more smoothly, having a higher income in revenue, which would be 6% increased sales, right? And 6% or more increased profitability. Because it's kind of like 1% the first month and then 1.1%, so 2.1, right? And it builds on each other. You're getting compounding effect within the business too. So what happened during those first 6 months? Joe got serious about giving every dollar a job, including some toward that safety net. Anything that Joe was bringing home from the business got allocated, and a portion would always go into that safety net. And Joe realized by doing that that the business income wasn't going to cut it, and took on a side gig in order to fit with the business goals, right? So that side gig would bring in personal income, but it wouldn't distract from growing the business. Be kind of a temporary situation until the business grew enough. And of course, what happened within the business during those 6 months? Renegotiated costs with vendors, staff paid closer attention to wastage and upsells, right? Both the increase in the revenue and lowering the cost. Wastage is a huge cost. And then Joe just learned a lot from wise business leaders and through trial and error. How do I make these 1% improvements, have them stick, that kind of thing. So tremendous change over those 6 months on both the personal and the business side. But then over time, other things started to happen. Personally, that safety net came in really handy to get out of debt, which remember, that was one of Joe's priorities. To travel internationally, have a little bit of fun. Wasn't a priority at the beginning, but became one with all the stress of business to have a little bit of fun too. Purchase a home, that did happen, and more within that time frame. Those are just kind of three things that happened personally. Professionally, that safety net really helped when the business came to a sudden halt. That safety net was used to keep the business or get the business back up and running without having to go into debt or grovel to a bank or charge on a credit card, that kind of thing. And ultimately, that safety net really was helpful to help Joe sell that business and start a new one, both in showing, look at all these improvements we made in the business that we could take home this, take home pay, right? Was kind of the language there, which is attractive to, a potential buyer, that they could actually have profit from the company. And then also funds that could be used then to start the next business, the next endeavor. And that's not all. The Joe's still living this story, and Joe wants to continue to grow that safety net and make it more than just a safety net. Actually, make it an investment fund. Maybe Joe invests in real estate, in stocks, in crypto. Who knows? Maybe into other businesses or more into Joe's new business. But ultimately, the goal is to have this safety net and the an investment fund and what's working there, ultimately to use it as a source of passive income with continued safety. And professionally, um, that safety net gives the ability to take a little bit more risk to grow from just being a small business owner to being truly an investor, not necessarily, in the things on the personal side, but really in people, growing the business, having more staff. Giving more responsibilities to those staff to help them grow, and and having all of us make more money together, right? Is kind of the idea there. Um, so lots of possibilities here, but now you can see this case study of how starting a bank on yourself designed policy helped this entrepreneur over the past several years to do lots of different things, and how uh, she sees it helping her in the future. So let me ask you, what do you think? Is a properly designed high cash value dividend paying life insurance policy right for a young entrepreneur? Now, I did talk a lot about benefits that were outside of the policy. There were definitely things that Joe did that weren't really the policy doing them. It was Joe deciding to do different things. But I don't know if Joe would have decided to do those things, right? To focus really thoroughly on the profitability of her company, that kind of thing, if she didn't have that safety net building and know what it would do for her, right? So I wasn't just talking about the policy, I was talking about what that policy did for Joe, not just in terms of the dollars and cents, but all of the things you might not think about if you're just looking at a spreadsheet. I hope you found that helpful. Something I think really important to think about as you're deciding how you would answer this question about if this would be right for you. And kind of the biggest objection that I hear, especially from young people about these policies, I'm going to address tomorrow in episode 100. I look forward to sharing that with you. It's going to be an extra special treat for you with the next episode. It's not tomorrow, it's Monday when we're releasing this video on a Friday, but the next one in sequence. For now, thanks for joining me and connecting with the FIFE movement. As you go about your day today, remember wealth is coming your way. Your quest is to prepare for using it well. For more tips on how to prepare, be sure to subscribe. And to connect with the community, visit fifemovement.com. My gift has helped you today. Please pay that gift forward by sharing this content with a friend. My gratitude in advance. Thanks for watching on YouTube. If you liked this video, please hit that like button so that more people will see it. And I invite your feedback in the comments too. What did you think about looking at these policies, not just in what the policy itself does, but also what focus and determination it gave Joe? Do you Is that helpful to think about it, not just in the dollars and cents, but in the kind of intangible benefits? I'd love your feedback on that, and be sure to join us the next episode where I share the top objection. I'll talk to you then.